Good morning, everyone, and welcome to the European crossover webinar. And we're seeing the euro under some pressure right here as a victim of some of these PMIs, and we'll take a quick overview of that right now. We just got in the Eurozone PMI, which came in at 51.20, a little bit better than was expected. They're looking at 50.8, but we did start out with some disappointing numbers here, more so with, you can almost say Italy's expected. Obviously, they're expecting 50, and they've slid into recessionary territory. Anything below 50, I guess not recessionary, anything below 50 is considered contractionary. But also France, that's a big one here. I mean, you would expect from Italy with their woes, but France, they were actually looking for 47.5. They got 47.8, so a little bit better than what was expected. But certainly being in contractionary mode certainly doesn't help anything. And the prior one was 49. So we were already in contractionary mode, and we're just slipping further here. We just didn't slip as much as they expected. But certainly it turns things down. Spain, which has been doing overall well for about the last 18 months or so, came in at a solid 54.7, even surprising right here. But as I mentioned, as we got Germany, I mentioned on there we had 52.0, but that's actually the services right in here. But you can look on here at 53.0 was the initial number, okay? And once again, still a little bit on the weak side, certainly more than what was expected. So they're glad about that. And this came from 51.80, nice big move here as far as that goes, but it was the composite that was 52.1, but services 53 here. Now we did get Eurozone PMI, and right here we've got 51.0, certainly better than expected. I think what really helped them out was Spain, which I don't know if you can garner a lot of support or whatever. Is that it's Spain that's actually kind of pulled them out of the rut here, that they ended up doing a little bit better than expected because we had such a nice solid performance out of Spain. But that's nothing to just not consider. But as far as pulling them out, it's not the same as if we got a big surprise to the upside for Germany. But as I said, we're down here. One of the things that we looked at yesterday are Bosch chart support was right here. It actually had listed as 1428, but we talked about the importance of a daily close above 1426. We mentioned that yesterday or the day before from the analysis from the Sunday session, is that, we had held above this 1445, which you can see here, that's the breakout area, okay? And the market, if we dip below that, and certainly we're going to start out the week as a defensive, okay, but it was important that we hold 1426 on a closing basis, and you can see here, because if we lose 1426 on a closing basis, it just shifts the momentum lower. It isn't a matter of, okay, we close below 1445, bears are on the defensive, but as long as we close above 1426, well, 1426 did go in and hold right in here, and we popped back up. And actually in Asia we were pushing up higher. I think we might have made him to 1440s. We were trying to pull away, and now we've opened up. I guess maybe the concerns also were certainly warranted, which was in these lower PMIs, and now we've pushed lower here into the euro. Cable a little bit on the weak side here too, pushing down here. And when we also take a look here at the cash dollar index, and I did do some basic technical analysis, or I always put mine under basic technical, but I did some on the posted into the basic technical for the dollar index. And one of the things I was noting here was we closed just above this key area here, this 95.80 right there. We'd closed just a hair above that. You can see that here. And that opened the door for us to move higher. But the next key area, and we talked about this, was that in order for the market to turn things around, because one thing you can see is on the exponential moving averages, we're still in the sell mode here so far, but hard to believe if you think, whoa, how can you be that? Well, we saw that before when we saw this sharp rebound, remember, in the dollar index. Matter of fact, we made it all the way up to the 61%, although we failed there, and then 96.72. So this looked about as strong as can be, but the exponential moving averages were still in the sell mode. and then we lost gas, ran out of gas. Well, we're certainly seeing this sprightly rebound in the cash dollar index after the FOMC. Once you can remember, is when we dipped down here, we had 95.35 as support. We dipped as low as 29 that day, and then the Asian session we dipped a little bit lower, and then hence since then we've been really coming back nicely. Well, in order to get things turned around, this is the key right here. This 96.07 on a daily close. If we can get above 96.07 on a daily close, now that shifts things to outright buy mode. Certainly on a very short-term distance, you think, what do you mean? Certainly, I'm sure the dollar index is in a buy mode, but it would be in an outright buy mode on the daily chart if we get that daily close at 96.07. Anybody that would be bearish would have to essentially throw in the towel if we get a daily close above 96.07. So keep that in mind. Onto the gold market, we certainly saw a pair back from this area here, this 1323, and the market certainly had the opportunity to try one more time. It looked like we might get that, but yesterday or coming into the Sunday session, we started to slide back, and slide back we did, slid back even further. We talked about this yesterday. I think there's still the potential for 1304, although on a very short-term basis, I think we had 1307 as our bias chart. I don't think it even made it there. Come down here. Yeah, 1307. Oh, not that far off. The low was 1308, so not that far off at all. But I think there's a potential for a move down there to 1304. And we had a resistance at 1315. You can see here, this is where we ran out of gas, if you want to call it. And you can see why. As we come right up to this little ridge there, there's your 1315 in the market. And that's actually in the gold. That's not on the XAU. So let me pull this back out here. That was on the XAU. Okay, just want to make sure, giving the right information. It was 1315 if we rotate a little bit lower from there. I am seeing the bunds have come off. I just wanted to go on and make a note here. Bunds are under pressure this morning. Look at that. Kind of a bit of a surprise here when you think about how weak PMIs are. One of the things that we did mention last week was, and I think the reason the bunds are under pressure, and we thought the euro could find themselves under a little bit of pressure, is remember we had bonds being sold this week, and so that's probably put certainly has put on pressure. Here you can see the bunds pairing back. You think, boy, that's a bit of an oxymoron in the sense that here's bunds pairing back when you've got weaker PMIs, but we have supply, and that's probably what's pressured the euro. So keep that in mind, in the back of your mind, though, on this. With that, we're going to move on to the morning bid. Britain's Theresa May heads to Northern Ireland today for a two-day tightrope walk over the infamous backstop, the deal under which the UK must remain in a customs union with the European Union until new arrangements are found, ensuring there's no North-South Irish border post-Brexit. Despite Angela Merkel's intriguing hint yesterday at the need for creative solutions, politicians south of the border in Dublin see the backstop as a prerequisite for protecting the advances made by the Good Friday Peace Agreement. North of the border, indeed in the Westminster Parliament, May is also under pressure to ditch something which Brexiteers fear will lock the UK into alignment with the EU forever. Today she gives a speech and is due to meet DUP leader Arlene Foster tomorrow, most likely a key encounter in shaping her new pitch to Brussels. Back home, Nissan's decision to pull back manufacturing of its sports utility vehicles from Sunderland is raising yet more questions about the less than fully transparent sweeteners offered to Japanese company in the first place. If Nissan still wants government funding for its UK presence, it will have to reapply, the government now says. The risk is that the saga sullies Britain's image as a place to do business. The EU, meanwhile, is getting itself tangled in Venezuela. A bunch of European nations, Spain, France, Germany, and the UK among them, confirmed on Monday that they were recognizing opposition leader Juan Guaido as the country's legitimate head of state, but a joint EU decision to back him was blocked by Italy. A number of other European countries remain deeply concerned about what precedent such an overt intention in the politics of a faraway country sets. The bloc is now discussing more of the travel bans and asset freezes that are already imposed on 18 Venezuelan officials accused of violating rights and the undermining democracy. But experts say such sanctions have little or no impact on Nicolas Maduro's policy so far, and that an oil embargo, which the EU is not discussing, is the real lever. Few doubt that the soft power the EU can wield in its immediate neighborhood, but after the setbacks it had defending the 2015 nuclear accord it promoted with Iran, this is the latest test of whether it really wields any influence further afield. French unionists and yellow vest leaders called for National Day of strike and protest. Okay, well, that certainly has probably weighed a little bit on the euro too. Certainly, when one of those glasses half empty, when things look worse or things are not in good shape, then any little bit of bad news exacerbates. And certainly, we're seeing that here with the euro on top of the PMI. So that just added more to the downtrodden mood. With much of Asia on holiday for the Lunar New Year, the focus has switched to corporate earnings seasons in Europe and the U.S. Wall Street stocks recorded recent decent gains overnight in the slipstream of Friday's impressive employment report, and with the Fed confirming its policy direction. For now, it's entirely data dependent, with the S&P now up 9% from 2019 so far. The VIX volatility gauge has fallen to its lowest level in almost 4 months. U.S. futures markets hesitated first thing Tuesday, however, as Google parent Alphabet stock dropped 3% after a bell last night as questions above forecast headlines and fretted about its higher spending. European futures were also more upbeat, indications of a 0.5% gain, even though similar jitters for its tech sector rattled with some important bellwethers. In currency markets, the dollar index held most of Monday's gains, although dollar yen failed to retain a foothold over 110 after popping above there briefly. We'll get to that. Euro dollar nudged towards 114. The Aussie dollar rose 0.5% after the RBA left key interest rates unchanged, but it seemed less dovish. Going into today, we mentioned we have the services PMI, and let's see what else here. Canada December trade balance. And a reference here to the Canadian dollar edging lower against its US counterpart as Monday. Oil prices fell and the greenback broadly climbed, but the loonie kept hold for most of its 2019 gains. The loonie has climbed 0.4% since the start of the year, despite last Friday from the CFTC, which had been delayed due to a partial shutdown. And Reuters calculations showed that speculators raised their bearish bets on the Canadian dollar. And quickly moving on to the Aussie dollar. And as I mentioned before, over the last week and a half, the news that we do cover will be very, very slight. Only what is what mainly affects if we have any specific news on a market. The Aussie dollar rebounded on Tuesday after the country's central bank held interest rates steady and sounded less dovish than many bears had been betting on, forcing a round of short covering. The Aussie dollar popped back up to 72.55. Having slipped as low as 71.94, the RBA ended its first policy meeting of the year, reiterating the standard line that further progress on unemployment and inflation was expected, even if it was likely to be gradual. However, the RBA stopped well short of an explicit dovish shift in its policy bias, as many speculators had wagered on. Some thought it might choose to echo the Federal Reserve, which last week all but abandoned plans for more hikes. Retail sales figured out on Tuesday showed a 0.4% decline in December as shoppers cut back on household goods and clothing. Retail is worth about a third of the total household consumption, so the early indications is that total consumer spending growth will be soft in Q4 as it was in Q3, warned CBA senior economist Gareth Aird. Despite decent employment growth, tightening labor market, and a gradual lift in wage growth, spending growth has eased, and one of the culprits for consumer. And the New Zealand dollar was dragged hard by the Aussie, rising to 68.99 after a trough of 68.71. And let's go on and move up and wrap up with just the dollar overall. The dollar held on to its recent gains against its peers on Tuesday. The Aussie dollar reversing gains. We did cover that. The overly pessimistic view on developed economies, that the overly dovish view is being unwound, Masafumi Yamamoto at Mizuho Securities said. Trading was likely to remain subdued in Asia, with many markets across the region closed for the Lunar Year holidays for much of the week. This may have slowed down FX a little bit. I'll tell you what, FX was just completely dead yesterday. Be a moment. The index rose 0.7 after dipping last week below its 200-day moving average. It gains its treasury yields with that of the 10-year jumping 9 basis points over the past 2 sessions. The key message from the RBA seems clear: to have a weaker gradual global outlook, ongoing steep declines in Sydney and Melbourne housing prices, and concede that the third quarter GDP report was a fizzer. Now, the euro was flat at 14.38, but we know we've since dipped down to 14. There's room to rise for the 2-year yield. The sterling was flat at 30.38 after seesawing during the previous session on uncertainty over the way Britain will leave the European Union. Well, we did see that the cable was actually sliding a bit on its back foot here. See, we're not just kind of things have continued to remain a little bit on the weaker side. With that, we're going to move into the euro, move into the bias chart. Looking ahead, we do have Canadian trade balance at 8:30 Eastern. And we do have a market final PMI here at 9:45 Eastern. ISM, non-manufacturing, comes in at 10 a.m. Eastern. This should probably move the market, move the needle a little bit, so watch that at 10 a.m. Eastern. Not as much as manufacturing, but certainly have a little bit of a move on the market. So let's go on with the bias chart. Now, yesterday we had 1428 as our support, I should say, and we spoke about the significance of a close above 1426, which we made that dip. The market held there. We popped up. Actually, in Asia, we were working a little bit higher here in the euro before it turned around and slid back. We're trying to work. Look at that. We made it up here to about 1440, and as I said, we held that 1426 area and little by little worked hard, and then we just started easing back, and then certainly the PMIs weighed on the market. Not only weighed on the market, but certainly there was the protests in France certainly didn't help things any better. We kind of pulled back from this area here after this dip, so we'll take a look here where we stand here on the daily. Well, once again, we talked about this. We mentioned it yesterday. It's important that the market close above this 1426. If we can't close above 1426, and we did yesterday, we tested it, and we popped back up. Not by a whole lot, but we defended it. The key thing is, as we mentioned before, is that 1445 was a daily breakout level. That's the thing that opened the door for us to move higher. But as we slid back, we came into NFP day. One of the concerns, and we talked about that last week, was before that, we were seeing the market, when we started pairing back, it was we referenced this, and not being a fractals person, but it was eerily similar to the exact same move that we'd seen. Notice how everything was being constructed exactly the same way. You know what I mean? And then we took the dip, so the market was really open. And why? One of the reasons I was looking for our initial resistance at on NFP day at 1488. We still had 1532. Well, we ran out of gas right there. I think it was at 1489. And at the time I was long, ended up dumping half, I think, right before the NFP, and then another half just right afterwards, if I remember correctly. And so that was my concern. And certainly we've worked lower. So it was like I've seen that movie before, because this looked exactly the same construction. The market was acting. And then when you look at it, then you would go for a drift. And a drift we have. Now we've dipped down here. Now you dip. Not as much, but certainly almost playing out to the same thing. So that was a concern there. So when we look onto the daily, it's important that we close above 1426. Once again, if you lost to 1445, okay, because the market was under some pressure, bears were under some pressure. But that being said, if you lose 1426 here on a daily close, it really shifts the momentum lower for further follow through. So it's going to be important that we can defend 1426 on a daily close. So let's put this here. Support right now is going to come in right there, 1426. That's our support here for today. Important that we defend 1406. I mean, we're coming off of that, and I think once again, although we are under pressure, the market's trying to hold a little bit towards these lows, and we've gotten past the PMIs, but it's important that we get past 1426 on a daily. Let's move this. We can see if there's any confluence here. Just below that 38%. Well, and 1402 would be the 50%, but it's 1406. This can be our support for today. Certainly, you can see here when we made this rebound here to 1440, notice how it still remained in a sell mode. You see here, and now we've rotated lower here. On a short-term basis, and that's very, very, very tight, but resistance is going to be right there at 1459. This is our initial support. Remember, as we came in to start the week, and when we came in and we're doing the analysis yesterday at this time, we were sitting right there at 3062, and this opened the door for us to, we closed below this, and we had 3018. This is actually our support here. Remember, that's at 23%. Let's take a look at this. And you can see the support level coming in right there at 3017. And that's at 3018, which is at 23%. So when we look here on the buy chart, this is going to remain the same, 3018. Can't help but think we got to go down here to go and test these stops here with resistance coming in. You can see this coming right in here and right there. It's going to be 3094. quick little, look at that, just quick little stop run just above there and came right almost to here before we quickly turned and slid right back. Well, we had our resistance yesterday. I mean, resistance. Keep saying that support here, and that in the Asian analysis we had mentioned that 72. I think we had it 72.02. Actually, here 72.04 was our bias chart, but there's the daily support here, right there, 72.03. I guess it goes 72.02. We came back rather smartly from the RBA. The thought was that they thought they would have been more dovish, and they certainly weren't dovish at all. We saw a nice rebound. Now, we were looking for potentially, we said that we would see a lot of avid buyers coming in at 71.66 because the market was certainly under pressure. But we only just took a brief respite below 72. And obviously, with the RBA not being quite as dovish as most had expected, certainly caused back a rebound here. If we look on a very, very short-term basis, let's take a look what kind of a rebound that was. Looks like a little bit more than 61%. Yeah, more than 61, not quite a 78. That's resistance right there, 72.69. You think about it here. They weren't as dovish, but what we might do is we just might languish here for the day. But certainly, it still doesn't change the negative housing market that they have. They had mentioned Melbourne, and I forgot where else. So we might end up doing is having to come right back down and test this area here. So we'll go 72.69 for our resistance. We had 72.04 previously, and that ended up really holding. My guess is we'd still have, it may take a while, but we'd have to move lower to test this area here. Yeah, you saw a good smart rebound. The key would be is, can you see a further advance? At this point, I wouldn't think it'd be likely. Support, yeah, you can make the case for 72.04. Actually, on a super, super short, like an intraday, the support would actually come in right there at 72.16, probably even the case right here, although that's a little bit too close. I think they're going to end up having to come back down here and challenge this area. So looking further out, I think we'll eventually have to come down to 71.81. Now, we talked about in the Asian analysis from yesterday was that we expect some good, strong buying to come in, really at 71.66, but now we've come down here and caused some short coverage. So probably eventually is where we had to end up having to move back is that key level. Remember the 71.42, somewhere close to that. In the meantime, we're going to go right there with 71.87. That would allow them to take out these stops because I think in time this still doesn't change. The RBA wasn't as dovish as most people expected. You got some short coverage, but short coverage is a whole lot different than real buying. So I think in time we'll have to come down here and test this area, and that'd be 71.86. Well, look here. We finally cleared 99.89. Not by a whole lot, but we're right there, 99.99. And we're holding just above here. The resistance on a very short-term basis, and you have to take that into consideration, is going to be right there. Par 22. It's actually par 23, so. This is a big deal if we're able to close, get a daily close above this area right here, this in 99.89. You can see that was holding this market back. I mean, look how many challenges we've had here. This on a daily, this isn't like a 2-hour chart. Look how many challenges at 99.89, and we simply couldn't take it out. If we get a daily close above this, it's really a big deal. So we want to keep on the radar here. But once again, the dollar Swiss is not the canary in the coal mine it used to be, but certainly closing above 99.89 would certainly be a big deal. Support would come in right there at 99.70. You can see here that the dollar CAD is trading relatively quiet. One of the things that we got past that, remember the 31.20, that was a 61%, and we held this key weekly support here. We talked about that. Let's go jump back in here into the weekly, keeping things in perspective. You can see here, key support there was 30.89 right there. Now we're just holding just above that. But this market has certainly gone quiet here. No change here that I'm seeing here in the dollar CAD. And I don't know why this has it right here. Oh, well, the 34.3, if we broke past that, yeah, because if we did break past, this is that area that we were going to go and challenge the 30.43 here. If we're able to break past, and we didn't want to leave that option here, we're holding the 30.89. That's a key weekly support right now. But if we know that this is the area that would be attracting right here, where you see some good volume come in. They're trying to hold its own right here, and resistance at 31.52. So we're kind of trapped a bit, not trapped, but we're in a little bit of quagmire. We're not making any real movement to the upside, and certainly not making any real movement to the downside either. Moving on to the crude oil market, we did make it up in here fairly close to that 38%. Tried to nudge it up just a bit higher. You can see it here, made up here, right there at that 38%, right there, 55.60. So we were looking for a bit of a pause back here because we thought we'd already had a pretty mercurial run. And remember how well we'd finished up on Friday. So we've made it right up in there. You can see here, make it 55, 50, well, 55, 60, and that's a 38%. And we saw the market actually pare back a bit. We're coming. Let's take a look here. Better closer eye. You can see here 55.60 was the 38% of this entire move, and they stopped right there on the dime. And then we saw quite the pullback. Look at that, was because we already had such a huge run on this market. And so you saw, some decent liquidation, but the market came back in here. We actually defended here. Finally, they turn around and they're trying to push this market right back up again. Certainly, probably the Venezuela thing probably having its own supporting factor. Once again, the difference. Remember, we mentioned about the glass half empty. Well, with the euro, PMIs, French protests, any bit of negative news is going to weigh on the market. Well, this is kind of like the opposite here. Then the glass is half full. So any kind of positive news. Also, remember the momentum of the market has certainly been to the upper side here. So from a technical standpoint, and crude trades very, very technically, they quickly bought this market back after a pretty good dip turnaround. And you would have thought after a rebound here, we might kind of pare back a little bit, maybe towards 54.04 to pick up a little bit of some new buyers. Heck no, it sat there, and now we're pushing up even higher. Resistance on a short-term basis is really going to come in right there at 55.04. We're not even very far from it. So we'll go 55.04. That stopped this on a dime, but that was in a way an easy call because it was at 38%. That was the high to the pip, or tick, I should say. It's going to be 55.04. So we're only 10 cents away right here, right there. There we go. 55.04. Support, come in right there. 53.83. 53.83. Still a pretty good fallback here. Let's go and take a look at this on the 30-minute. If we were to fall back that far. Here's the thinking, though. Anybody who turned around and said, oh, yeah, this was overdone, I'm going to sell it here, which is 54.36. And then now they find themselves down 60 cents. Not a whole lot. And I'm just saying, if you're day trading or you're holding for a short-term basis, now you're thinking, okay, we'll finally break lower. And then they turn around and zip them up higher. Support then, I don't want it to be that close, at 54.43. I'm going to come in right there at 54.12. 54.12 for support. As I mentioned, 55.04 is going to be the resistance right now. Let's go and move into the dollar yen. Certainly the fortunes have changed for the dollar yen. And to me, once again, it was all about the technicals. And, this kind of saved my bacon here, is just going with these, once again, these levels where they close above. And one of the things I looked at on Friday was my concern when we were getting this nice, strong 2-hour close after the NFP, was that we were going right back above this 927. The market was recapturing itself. But one of the things I noted yesterday is if you were bear, you did not want to see a daily close above 977. We did the analysis because a daily close above 977 opens the door to challenges 1034 for starters. I'm not saying that the dollar yen is going to the moon or anything like that. And certainly it looked like it was finally going to maybe turn lower, although we saw that strong movement up on Friday. But for starters, you get to 1034. Now, we ran out of gas thinking the low 20s, or maybe we didn't even make it to the 20. You can see right here we made it up to 1016. But the thing is that when you're looking at it from a technical standpoint, I'm talking about just these levels. Anybody who is bearish, they got to get the heck out of Dodge. When you close on, you're saying, okay, I still believe it's lower, still believe it's lower, still believe it's lower. Look, if you close, it's one thing to close on a 15 minutes, another thing to close on an hourly or a 4 hour if that's your chart of your mode of preference. But when you close, you take out a daily. See, we talked about this with the dollar Swiss too. But you take out this 977 on the daily. Look how that's been holding the market at bay. Once you take that, then people are going to relinquish, even if you're not one, others are. So it opens up the momentum to push higher. So right now, whether we get there or not, the initial move is to challenge the 1034. Now, whether it happens or not, but we're knocking on the door right there at 110. So resistance right now is going to be 1034. I did some work in the posted the work in basic technical in the Asian session. I think I had that support at 965, but we'll take a look right in here. We'll go with that 965. Go with 965 on the intraday. But you can see now whether we push higher or not, the door technically is open for them to challenge. And I tell you what, the only way this can, it doesn't necessarily turn bearish, but it loses its upside initial push is if we'd have to get a daily close above 977. It doesn't turn it bearish, although from the exponential moving averages, we're still in a bearish mode. What would happen then is if we were to close below 977, it questions the upside. It makes you think, okay, was this a fake out? And at this point, then some people will take short positions. Others will say, well, wait, let me see some momentum, challenge that, get some downward momentum. But once again, like I said, you'd have to get that daily close below 977 to get things where what bulls might say, have an area of doubt. Here's another one here on the Aussie yen. We pushed up and look, here's that key level here, the 79.56. Very good, decent little resistance here. But here's the issue then. These doggone S&Ps just keep on moving higher. You see what I'm saying? Look at this, now at 27.23. So it almost has no choice but to move higher. Now the market did show a little bit of tiredness, and I think we had 79.80. Let me think if we kept the 56. I think we kept the 56. Yeah, but we had 79.80 as a little bit of a level. We'll go and adjust this, but as long as these spoos hold up, that's what's holding this thing up. And tell you what, I knew some big traders that really got skunked big time on this move here in the S&Ps that really hung in stronger than many would have expected. We'll take a quick look on this. We're even above this. Look at that. People would have thought that 2703. Me too. Look at that. Would have thought this would have held. Look, you had some good volume here. You had the 61%. You had great confluence here. And we're still trying to push higher. The next key area is right there, 2740. This 2725 is not bad in here, on up to right here. 2740, so for between 2725 and 2740. Of course, we have State of the Union tonight from Trump's speech, so that may keep the S&Ps, I won't say elevated, but may not move as much until we get past that. So I wouldn't look for a lot of reprieve off of this if you're a bear, probably until we get past the State of the Union. We're going to leave this at 79.80. There was also let's take a look here. Got some good resistance there too. They're trying to make that push. I think we had our resist support was at 79.18, if I remember. The 79.19. That support right now is going to be 79.23. Not much, but just adjusting it just a bit higher. Moving on to the Dixie. Well, we've already talked about this quite a bit, and it was able to defend this from the FOMC day, and we've continued to push higher, a little bit higher, a little bit higher. We still remain in a sell mode on the exponential moving averages, but the key is 96.07. You get a daily close above 96.07, and there's no denying that. So it's all about 96.07. Support, it's going to be 95.65. How can it not be that? It's 95.65 at this point. That's a key weekly. That's a bounce area where they lost momentum, where they regained it. Once they regained that 95.65, it was blue skies ahead. And now we've regained it. We're trying to push a little bit higher. So it's 95.65 for support. I don't see any changes here in the gold market. Here we are on the daily. We talked about this 1323. That was at target level, confluence with the 78%. The market still had the opportunity to push even higher and was actually still holding up relatively well on NFP day. Finally, we succumbed to the pressure. I think that the downside, a move to the downside is within reason, 1304. We had our support here yesterday at 1307. The low was 1308, actually 1308 and change. I'm going to go with this 1304 because if we do hit some stops, it's not that far away, and a respite to 1304 is reasonable. So we'll go with 1304. So we'll actually move this a little bit lower. And resistance we're going to keep at 1315. Now, the one surprise in the ointment, so to speak, when you think about it, as far as the PMIs, has been the bunds. They've gone and pared back. But remember, one of the concerns for the euro for this week was the supply that we had coming in, and that was going to go away on the market. So when we look at where support's going to come here at the bunds, we're actually going to go with this 78%, which is going to be 64. We're going to call it 64, 64. And a lot of that supply. There's resistance right there, 64.96. 64.96 for resistance. Overall, it still has its bullish bent. But I think supply issues is weighing more on the bund right now, as opposed to PMIs being a supportive factor. We talked about the potential for this to move a little bit higher with the support of S&Ps. Well, they're moving higher, much higher than what I would have even thought right now, but they are moving higher. Certainly the S&Ps are providing that. And we had we had 12,235, and we've even pushed beyond that. The weaker. Here's the deal. I would think we would rotate lower, but the weaker PMIs open the door for the ECB not taking the action. They're getting also some support from the S&Ps, and once again the PMIs are not as bad. I mean, they could be worse. So, although I would think we need to rotate lower as some of these numbers come out of weaker in Germany, but the German PMI was not bad at all. Okay, so that really opens the door for. I don't think it opens the door for new buying. What it does open the door is for some additional short coverage. Anybody that was short in here is forced to pay the piper. It's a matter of at what point is the uncle point. Well, for right now, we'll go with the uncle point. It's right there. It's 13, 11, 316. But I'm going to push it just a little bit higher right there. You see right here? Right there. That's going to be resistance 11,358. They're able to push this beyond this. I'm going to go with that going into tomorrow, 11,358. Thinking they'll get some more additional short covering potentially if these S&Ps can retain that area. Support, we're going to keep it pretty tight because I think any dip back, they're going to try and step in and defend this. So support is going to come in right there. I'll go right there. 11,138. You're just trying to hold its on after touching these at lows, but it's going to be 1406 is that area of support. Gold just pulling back a little bit, and obviously the dollar index right here. We had 95.90 yesterday support, but really it's all about 96.07 and whether we can make that push. But it's going to be huge for them to get beyond, and huge if they were to get beyond on a daily close, which a daily closer to be 96.07. But that wraps it up here on the European crossover webinar. I'll go on and get this posted in the room. And thanks for joining us here on the European crossover webinar.